Obviously, you're known for your list of 10 surprises. We'll get to some of those, but let's begin with China, because one of the things you said last year was that we'd get a deal in the first quarter, and that is only happening in the fourth quarter, and it's only a phase one deal. We know that's getting signed next week. What happens next? Do we get more of a deal?
Well, I think we're going to have trouble getting a phase two deal, a deal that's more comprehensive, that allows free access of financial institutions to the Chinese market, that where they promise not to steal intellectual property. I think a broad deal is unlikely this year, but we'll have the phase one deal. But Bonnie, remember, phase one deal is a transactional deal. We sell them soybeans and pork, and we agree they buy that, and we agree not to raise the tariffs that was scheduled for December 15th. So that's a low-level deal. The big deal is still pretty far away from getting done, in my opinion.
So essentially, the phase one part of whatever deal this turns out to be, you say, is not really a deal. It's almost a precursor to nothing.
Right.
Does that mean that the stock market keeps rallying on it, though? Because certainly the stock market is. We're getting a signing ceremony, it appears, next week, which you know is not going to have a negative impact on risk assets.
I think the stock market has come to the realization that there's going to be a gradual decoupling between China and the United States. China's the number 2 economy. We're the number 1 economy. They're creeping up on us. It would be good to have a harmonious relationship with China. But I think investors have come to realize that whatever relationship we have with China is likely to be strained, and we've learned to live with that. We live with it all through 2019, and we're prepared to live with it in 2020.
Byron, as you say, we've learned to live with it. 2019, a year when stocks rallied, despite the fact that we didn't have significant earnings growth. We had all the China stuff that we had to deal with. There was Brexit. There was so much turbulence, yet stocks kept on going. And I guess liquidity is probably a big part of that. What does the liquidity story look like in 2020 that maybe keeps this stock story on the rails?
I think we're still going to have an up market this year. My forecast was the S&P 500 would reach 3,500, and I still think that's likely. I feel comfortable with that. I have some that's not too far from the consensus, but I think one of the reasons for it is that there's going to be monetary easing around the world, including in the United States. I still think we're not at the end of the Fed easing cycle. Most people think the Fed will stand pat with Fed funds rate where they are. I think we'll see maybe as many as 2 additional Fed cuts this year. And it's the monetary accommodation that will allow multiples to expand further, because I don't think earnings are going to rise that much. I only see a 5% increase in earnings, and that's less than the consensus view. The consensus view is earnings up 10. I don't think we'll do that well.
Why do we get Fed cuts? I appreciate what you're saying about multiple expansion. That was definitely the story last year. But the Fed sounds really comfortable where it is right now. I was listening to Clarida a little bit earlier on. The Fed doesn't sound like it wants to move right now. What's going to get it to move, Byron?
What's going to get us to move further?
Yeah.
Well, if we have easy money, that'll get us to move further. Money is the most important driver of the market. In 2008, the balance sheets of the central banks of the world were about $3 trillion. They're now about $16 trillion. This market has been driven over the past decade by liquidity, and I think that's going to be the case moving forward in 2020.
Byron, what do you make of events of the last couple of days? In your surprise list for 2020, funnily enough, you said Iran taking advantage of America's unwillingness to intervene and stepping up hostility against Israel and Saudi Arabia among your surprises. It turns out that, with the exception of the last part, it hasn't been a surprise. We've already had something of that.
Yeah, I'm going to count that one as a hit this year. I thought that Iran would strike first, but I did not think we would take anticipatory action. But they were getting ready to do things, and Trump said that very clearly in his 11 o'clock conference or press meeting yesterday. And we saw that they were planning this, and we decided to strike first and took out the Major General. So my feeling is that we recognized Iran's potential hostility. We took more decisive action than most people would have expected, and hopefully that will neutralize Iran. Hopefully Trump will have achieved his objective to tell Iran, look, we're serious. You do anything against us, we're going to strike back very hard, and you're going to suffer. Iran doesn't want World War III. We don't want a World War III. And at least on today, Thursday, it doesn't look like we're going to have one. Whether that mood endures in Iran and the United States is hard to say. But that's where we are right now, and that's why the markets are back to where they were at the beginning of the year.
A particularly concerning part of that prediction, however, is the hostility against other countries in the region. You specifically name Israel and Saudi Arabia. You also say that the Strait of Hormuz will be closed at some point and that oil will top $70 a barrel. Having seen how things have played out so far, do you stand by that prediction for this year?
Well, I never change the surprises. I'm still saying that if Iran wanted to take the most decisive action it could without firing a shot, it could close the Straits of Hormuz. So that would be a way for them to retaliate. Whether they'll go that far or not, we'll see as the year progresses. But that's something they could do that would really cause pain around the world.
That's the important bit, Byron, that it would cause pain around the world. Why does America care if the Straits of Hormuz get shut off? It's China that really has to worry about that. It's India that has to worry about. The U.S. has got tons of oil. China, India, these are the countries that rely on the Gulf. What kind of pressure are they going to put on Iran?
Well, I think they'll put pressure on Iran not to do that. They need the oil. Both India and China are deficient in oil. They're dependent on Middle East oil, and they're going to do what they can to keep the Straits of Hormuz open. So they'll put that pressure on, and that'll be a neutralizing force. So it increases the unlikelihood of that surprise taking place. But if Iran really wanted to take decisive action, that's something they could do. But that would drive India and China more toward the U.S. We'll see whether that happens.